Who is the fastest self made billionaire ever? While it took Warren Buffett 55 years to join the Billionaires Club, Jay Walker literally did it less than one. He launched Priceline.com during the dot-com bubble, and his net worth instantly jumped from zero to billions. But that wasn't sustainable because when the bubble bursts, his net worth crashed. The swell? Well, Buffett is still on the top of the list and he doesn't seem to be going anywhere anytime soon. And that's the kind of wealth you want to build. The game of money. It isn't easy, it's tough, competitive, and ruthless. And if you don't know, you are doomed to fail. The problem with most people is that they think they might work super hard their entire lives, but end up poor at the end of their journey because they don't know how to let their money make even more money. In other words, they don't know how to invest. Let's assume that you have been saving money and have an extra $1,000 in your bank account. That is already an achievement because nearly 70% of Americans don't even have an extra $1,000. So instead of spending it on another useless gadget or a pair of shoes that you would wear once and then keeping your wardrobe for many years before you finally throw it away, let's assume that you're going to invest that money. But the question is, how do you invest your first $1,000? Do you invest it in real estate or the stock market? What kind of stocks do you buy? Is $1,000 enough to start investing? We're going to answer all of these questions. So give this video a thumbs up and let's get started to understand what investing is and how it works. Consider this example. Let's say you work so hard to save $300,000. You can pay a visit to a Ferrari store and get yourself a luxurious car and let everyone know how successful you are. Or you can buy real estate and rent it out. Every month, you will receive at least $2,000. If you decide that you no longer want to keep receiving $2,000 paycheck every month, you can sell it and get back your initial investment. In fact, the value of your investment might even appreciate. So you will sell it for a higher price and that's how money makes money. But you can't buy real estate for $1,000. That's not enough for a drown. However, that doesn't mean you can't invest $1,000 elsewhere and let it grow. The easiest way is just to deposit it into a savings account and generate interest. But why would the bank pay you for keeping your money in the bank? Shouldn't they charge you instead? Now you see, the bank is going to take your money and loan it to someone else at a higher rate, and will share you a portion of that profit. That's how banks work. The only problem with this strategy is that interest on a deposit account is so low that it isn't worth it. The highest rate you can probably get is 0.8%, which means that if you invest $1,000 into a savings account, 12 months from now, you will receive an extra $8, which is extremely low because the Fed targets an inflation rate of 2 to 3%, which means if you're not getting at least 2 or 3%, at the time, the real value of your $1,000 will depreciate, which means you can buy less coats with it every year. But why are interest rates so low on deposit accounts? Because interest rates in general are low this year, forcing the Fed to lower them to encourage everyone to borrow money and spend a year or two from now. Once we get out of this recession, the Fed will increase interest rates to 1 or 2, even 3%, which means interest rates on savings account will rise as well. Your second option is to buy government bonds. I was born in security. That's issued by the government to raise money to support government spending and say the government wants to build this. But it doesn't have the money to do that. So it issues, and I owe you a piece of paper that says whoever owns the security is at this much money plus interest by the US government. Of course, this is an oversimplified example, but that's the point in short government bonds that are heavily influenced by interest. So since interest rates are extremely low this year, government bonds rates are less than 1%, But 2 years ago, when interest rates were high, government bonds raised was as high as 3%, which is not bad since the government bonds are the safest investment you can ever make. Any investment carries with a certain level of risk. If you're loaning money to the US government, what are the chances that the US government will default on it? For the US government to go bankrupt, the entire US economy might have to fail. That's why US government bonds are considered the safest investment in the world. But if you want to make a higher return, let's say 10, 20, or 30%, then you have to consider investing in the stock market. For example, Amazon's stock price increased by over 80% just this year. Google's stock price rose almost 30%. Tesla stock increased by 721%. Yes, you heard that right, 721%. Then the question is, why would anyone invest elsewhere when you can double or even triple their money in the stock market? The answer is risk. When it comes to government bonds, for example, there isn't much risk. In fact, it's risk-free to a certain extent, but when it comes to individual companies, there is a risk that the company might fail. It might report negative earnings, pretty much any negative news contributive the stock price. The company might release a product, and if the public doesn't like it, that could mix some negative headlines, which contribute the price down. So with high returns comes more risk. EPO is a well-established company, and its chances to fail are way lower than Tesla, for example, but it also has less room to grow than Tesla. That is why Tesla grew by 721% this year, but Apple by just 70%. What you have to determine 42 staff is how much risk you want to take without going nuts. If that $1,000 is all that you have left, maybe your risking it all isn't the wisest option. Because if things turn south, you can end up losing most of it. So one way investors minimize the risk in the stock market is by investing in an index. The most famous one is the S&P 500, which tracks top 500 US companies. So an index fund would basically invest in these top 500 US companies. Some of these companies will definitely fail, but others will be judged by historical data. The average return rate for the S&P 500 since the 1920s was around 10%. This means buying a share of these index sponsor means you're buying a tiny share in the top 500 US companies. My three top favorite index funds are VOO, or Vanguard 500 Index Fund, Triple Q, an index fund by Invesco, and Fidelity Zero Total Market Index Fund. All of them are great and invest in pretty much the exact same companies. But how do you buy shares in this index? I mean, where do you start first? You need to find a broker. Someone who is qualified to sell the stocks. In the past, it was always someone you had to pick your phone and call him and ask him to sell you some shares. Remember the Wolf of Wall Street? He would spend it on Child Day, calling people and trying to sell them worthless stocks. But thank God we are in 2020 and things are much better. Broker firms created apps so you can buy shares from the comfort of your smartphone, suggest Robinhood, Weibo, and so on. All you have to do is now download one of these apps and sign up, and you can start investing. I tried my best to make this video as simple as possible so that whoever wants to start investing can start right away. Often what happens is you want to start investing but you have a million questions and you start Googling this and that you get exhausted after some time. Thanks for watching and until the next video.